Most retirees assume that once their paychecks stop, their tax situation all of a sudden becomes easier. After all, you got less income, right? But unfortunately, that's not true. Retirement taxes are often more complicated than your working years. And if you're not careful, one wrong move can cost you thousands of dollars in extra taxes. It can also cause you to pay higher in Medicare premiums or even losing part of your Social Security to taxes. Hi, my name's Jeremy Finger. I've been helping people successfully retire for almost 30 years. And I've seen firsthand the costly mistakes people make when they try to plan their taxes on their own. And I've also seen the money they save when they finally get it right. In this video, I'm going to walk you through the biggest reasons retirees fail when it comes to tax planning, and I'm going to show you how you could avoid them. Now, stick with me until the end because I'm going to share with you a framework that pulls all of this together into one clear, simple, overall strategy. Reason number one, they don't understand the retirement tax timeline. A major challenge retirees face is simply getting a clear idea of their taxes in the current calendar year. Unlike when they're working and receiving a W-2 wage, retirees often have income coming in from multiple places: savings accounts with interest, mutual funds paying capital gains tax distributions, surprise stock buyouts, which can be taxable, and of course IRA withdrawals. Pulling all that together before December 31st is incredibly difficult, which means that they often don't know what their true taxable income is until it's too late to act. Let me give you an example. One couple I worked with thought that their income was going to be around $70,000 that year, but in December, a mutual fund they owned for a very long time sent them an unexpected $25,000 capital gain distribution. And one of their stocks they own was bought out by cash. By the time everything settled, their taxable income was closer to $110,000, not $70,000. That one surprise pushed them into a higher tax bracket, made more of their Social Security taxable, and even raised their future Medicare premiums. Now, they didn't do anything wrong. They just didn't see it coming. The lesson here is retirees often don't fail because they are careless. They fail because retirement income is unpredictable. And without a system to track and plan for it, these surprises can be very expensive. And if tracking income in a single year is challenging, wait until you see what happens when retirees rely on rules of thumb. And that's our next pitfall. Rules of thumb can be very dangerous in retirement. Let me give you an example. Always delay Social Security to age 70. Convert everything to Roth before RMDs. Don't touch your retirement accounts until you have to. These may sound like wise decisions, but retirement is not a one-size-fits-all plan. Let me give you an example. A high-earning couple converting a large amount of money to their Roth IRA while delaying their Social Security. It's great. It sounded smart. And they did it because a lot of other people were doing it. But for them, they paid way more in taxes, and they triggered higher Medicare surcharges. This cost them a lot of money and a lot of time, and they did it because they were focusing on the strategy and not on how it fit into their overall plan. Another retiree I met followed to delay their Social Security advice, but they ended up depleting so much of their IRA account, it left them fewer options later in retirement. You see, for this couple, they gave a lot of money to charity, and because their IRA was liquidated by the time R&Ds came around, they missed the qualified charitable distribution options that are available to them in their 70s. The lesson here is, what works for one retiree could be disastrous for another. Blindly following a rule of thumb is another way retirees fail. So don't chase the rules. Build a roadmap tailored to your particular situation. But even if you got the rules right, many retirees confuse a good investment strategy with a tax-smart withdrawal strategy. And I'm going to share with you on why that really matters. But if you're already finding this helpful and you want to see how these concepts apply to your own retirement, I put together a free training video on the Riverbend Bridge method. It's the exact process I use with clients to coordinate their taxes, income, and investments into one overall plan. The link is in the description. But let's move on. Reason number 3, they confuse investment strategy with withdrawal strategy. Here's the big mistake. Thinking a good investment strategy automatically means a good tax plan. You might have a diversified portfolio, and I even have solid returns. But if you don't have a plan on how to withdraw the money, you could lose 10 to 20% or more to taxes every year. Matter of fact, Vanguard did a study and said tax smart planning can equal between 1 and 4% after tax return on your overall accounts. So, withdrawal order matters. Do you pull from a taxable account or take it from your tax deferred IRAs or possibly dip into your Roth accounts? Each choice changes your taxable income, your Medicare premiums, and how much of your Social Security is taxed. Let me give you an example. One couple lived off of dividends from their brokerage account and let a $1 million IRA account go untouched. At age 73, they were forced to take RMDs, and that doubled their taxable income, forcing them into higher tax brackets and making all of their Social Security taxable. Another client had the opposite problem. They pulled from the IRA account because they were in a low tax bracket. It sounded smart, right? But they totally missed the opportunity to sell some stocks in their taxable account at a 0% tax rate. The lesson here is a portfolio without a withdrawal plan is like a car without a steering wheel. You need to constantly adjust it to keep it on the road. This is often why one-time financial plans don't work. As soon as an unexpected income need happens, it can derail whatever plan you just written down. But it's not only which account you pull from. Capital gains can play an even bigger role than you might think, and that's the next mistake. Capital gains are often overlooked. Retirees avoid selling taxable investments because they don't want to pay the taxes, or they sell without thinking. Here's what they miss. Long-term capital gains can be taxed at 0% if your taxable income is low enough. This can be a powerful planning tool early in retirement. Also, tax loss harvesting. Selling an investment at a loss can offset gains that will reduce your taxable income. But many retirees miss these opportunities. Let me give you an example. A retiree sold a rental property and didn't realize that capital gain would push them into higher brackets and trigger Medicare IRMAA surcharges in 2 years. That mistake cost them thousands. Another person I worked with was a retiree, and he avoided selling a stock because he feared paying the capital gains tax. Unfortunately, that bank stock went bankrupt in the global financial crisis. That one mistake cost him $1 million. The lesson here is manage your gains and losses as part of your bigger overall picture, not just in isolation. And if gains and losses can shake things up that much, imagine what happens when you treat every tax decision separately. And that's the next failure point. The biggest failure I see retirees make is treating taxes as one-off decisions. A Roth conversion here, a withdrawal there, a property sale here. Each decision may seem fine on its own, but in retirement, everything is connected. Your withdrawals affect your taxable income. Your taxable income affects how much Social Security is taxed. And your income affects your Medicare premiums. Let me give you an example. I met a couple who decided to do a large Roth conversion without considering the impact of Medicare premiums. That conversion not only cost them thousands in taxes, but also bumped their Medicare premiums. They were shocked when that bill arrived. Another retiree sold out his entire 401k account to buy an investment property, thinking all he had to do was pay his ordinary income tax. Obviously, that bumped his tax brackets up, but it caused them more taxes on Social Security, Medicare, and he even got hit with 3.8% net investment income tax. So that property had to return a 40% return just to break even to pay the taxes. The lesson here is stop thinking in isolation. Start coordinating your tax, income, and healthcare decisions as an overall system. So how do you pull all this together in one clear framework? And that's where the Riverbend Bridge method comes in. Here's how it works. Map out a timeline. Identify when Social Security starts, when RMDs hit, where your tax valleys and cliffs are. Model in some strategies. Test different withdrawal orders, Roth conversions, Social Security start dates. Coordinate these decisions to make sure your tax, healthcare, and income strategies all work together. Also, stay flexible. Laws change. They just changed this year. Life changes, and your plan needs to adapt. The goal is simple. Pay less in taxes, keep more in your pocket, and retire with confidence. Most retirees fail at tax planning because they're trying to do piece by piece, year by year. And the winners are the ones that zoom out, see the full picture, and connect every decision. Now, if you want to stop guessing and start planning smarter, you can watch the free video I have in the description, the Riverbend Bridge Method. It's a short free video and it can save you thousands of dollars in avoidable taxes. Thank you for watching, and I'll see you in the next video.